Insurance premiums have doubled domestically over the past decade. Now insurers are repricing risk to ensure they can keep covering us and their own earnings.
Last year we had number 2 and number 3 of our highest insurable losses for natural catastrophes occurring within 10 days of each other. And you definitely need to have a strong insurance system, because when things do go wrong, and in particular, as I mentioned earlier, in the event of a catastrophe, you need to know that that company is going to be there to support you through those tough times.
For a small island nation, we have our fair share of major weather events. Cyclones, floods, and earthquakes have devastated some of our regions and cities. They've also had an impact on our insurers' balance sheets, with Cyclone Gabrielle and the 2023 flooding events costing insurance companies around $3.5 billion. The seemingly increasing commonality is forcing insurers to act differently, increasing premiums as they relate to risk. The Reserve Bank regulates insurers because of the role they play in backstopping assets like property. Earlier this year, it released its deep analysis of the sector.
What we found in our piece of work on insurance affordability and pricing was a significant increase in premium prices, particularly over the last 10 years, where premiums have essentially doubled. That sort of 100% increase compares to around a 30% increase in inflation overall, so it is quite significant.
The increases were due to higher construction costs, making repairs more expensive, and higher reinsurance costs, because even insurers need insurance.
I'm not saying it's justified, but it's explainable.
But there's concern insurers are rethinking the risk of insuring New Zealand. With more data available on seismic and flood risk, they're able to make more concise decisions, which could lead to some policies being unavailable.
We may see some insurers no longer providing insurance in certain areas, so there could be accessibility issues.
At a top-line level, insurers are making more money domestically, with the total dollars earned in gross written premiums in 2023 hitting $9.5 billion, according to the Insurance Council. But they paid out $4 billion in claims that same year, meaning their loss ratio was 70%, compared with 50% in 2019. The watchdog wants to raise awareness on the risks this could all pose to our financial system. But rather than just repeating the regulator, I thought it best to ask an insurer how they're thinking about the impact this could have on their operations. Which brings me to Scott Pickering. You may recognise him as the once chief executive of the state health insurance scheme, the ACC, for 8 years. He's now a director on the board of big insurance companies, Fidelity Life and IAG, which has a near 30% market share through brands like State and AMI. If anyone can give us an honest insight into insurance, it's him. Well, Scott, good to see you. Thank you so much for doing this. I really appreciate it.
No problems. Lovely to be here.
I think this is quite a good conversation to have, because I feel like we know a lot about the financial firms in the sense of banks, but when it comes to insurance, we don't know as much as we should about insurers. Would you agree?
I think in a way insurance tends to be sort of like a little bit below the surface at times. I think what we do see, and when we really see insurance come to the fore, is obviously during times of catastrophe and really challenging periods in not our country's history, but globally. And that's when I think the need for insurance really comes to the fore. Let's face it, you pay a premium as a form of consideration, and you get an outcome when you get a claim, but you don't always have a claim. So yeah, it's a little bit below the surface, I suppose.
Kind of like that business that we'd never actually rather deal with, but in times of need, we absolutely do.
Absolutely, and that's the moment of truth. And I think for all insurance companies, they know that they have to be at their best in those challenging moments.
Quick run off of your experience, Scott. You did a long time with the ACC, now you're involved with Fidelity Life, the life insurer, and also IAG, the big Australian insurance group. So my thinking is then that you cover pretty much every single policy. You've got motor, home and contents, business, travel, probably everything other than pet, is that correct?
I'm not even sure, maybe pet does come up somewhere there. Yeah, Madison, I've been lucky enough, and I say that truly and genuinely, lucky enough to be in the insurance industry for over 35 years now. I was very young when I started. I've had the opportunity to live and work globally in the industry. We've lived in 8 different countries around the world. I think I lost count, but I think I've actually transacted business in nearly 50 countries around the world, which has been incredible. But the opportunity about 10 years ago to come home to run an iconic institution such as ACC was really compelling. So that in its way continued my insurance journey, and since then, yeah, now I've switched into the governance world with both IAG and Fidelity. So I'm still deeply involved in the industry, and you're right, I think my span, if you will, covers most classes of insurance.
Let's start with risk-based pricing, because I think for at least anybody in Auckland, the Auckland floods and also Cyclone Gabrielle, which did impact the country, are still certainly front of mind. Apparently there's this shift in the industry to more risk-based pricing. Is that actually happening? Is it true?
Look, I think in certain classes, risk-based pricing has been and is there, and you take data points. Motor is a good example of that, where companies have significant loss history for different types of vehicles. They can take other data points in terms of information, age of driver, where's the vehicle garaged or not garaged, and obviously there is a risk-based pricing for that particular vehicle. Now what we are seeing definitely in, say for example, home and contents or the home insurance market, there are some carriers who have come out and publicly stated around their adoption of risk-based pricing, and we understand why. I think it would be an intent for the market to move in that direction, but clearly in order to be able to put together a risk-based pricing, you need to ensure that you've got sufficient data and information in order to be able to individually target and price individual risks. And for those organisations who have perhaps a larger market share, for example, and those that are operating in the market, that'll be a transition to risk-based pricing rather than from here straight to risk-based pricing. So certain classes of insurance absolutely have risk-based pricing today. Others have more what I'd categorise as community-based pricing. So it's not so, there will be a specific of the risk, but in terms of some of the perils cover and all of those sorts of things that you talked about, that's not quite at that level to be able to individually price some of those risks today.
So fair to say it is happening to some degree, but it's certainly not widespread and certainly not on a market share sense.
No, I think you'll see the market move towards that over time, absolutely, and I think that that's something that the reinsurance market would also be expecting to see. So I think we'll get there, but of course importantly, both from a customer point of view and an insurance company point of view, you've got to have the right data and information in order to apply the correct risk-based pricing.
Well, I was going to ask you about that, and we are going to talk about reinsurance a little bit later on in more depth, but on the risk-based pricing, how do you know that once you do start shifting to it or where it is being used, that the pricing is right for the risk? Is there a formula?
Well, I guess that will be both actuarially and statistically based, and of course, models of floodplains and natural disasters are an evolving science. I think we saw significant enhancements, if you will, as a result of the tragedies that occurred from the Christchurch earthquakes and more latterly Kaikoura. There's much more data and information around liquefaction and areas such as that from an earthquake perspective, and that's built better modelling for pricing associated with earthquakes, and I think we'll see the same sort of thing occurring with things such as floods, etc.
So it's definitely being used in the seismic sense on things like property at the moment.
Yeah, definitely, but by zones, not necessarily by individual risks at this point in time. So that's an evolving science.
For every business, and especially for investors, they will very much understand risk versus reward. And I wonder what the intent is behind risk-based pricing. Is it because every business nowadays needs to make data-driven decisions where that data is available, how we're even doing it here in this newsroom? Or is it to protect and limit the risk of the reward that insurers make?
Yeah, I mean, I think fundamentally it's probably, if you think about it, it's applying a premium based on the risk itself in an individual state. So, we've got property X located at this location. We kind of understand that it's susceptible to these types of risks. It's taken this level of mitigation, and therefore there is a premium associated with that risk. There is, clearly a number of factors that drive towards it, but I think it's just about more specificity by risk rather than in a broad-based sense by community. If that's the kind of, if you're looking at it through the home lens. And as I said earlier, we can clearly understand that when it comes to things that we understand pretty clearly, like about a motor vehicle. And this particular motor vehicle, we've got the statistics and data that shows this particular motor vehicle is more susceptible to theft versus this particular motor vehicle. This particular motor vehicle costs this much to repair, this particular motor vehicle costs that much to repair. And accordingly, then you can start to actually specifically put premiums associated with the risks themselves. So it's an evolving science in certain classes. It's definitely more specific in others.
Is there a risk versus reward scale across different types of insurance policies? For example, does life have a larger reward and less risk than, say, something like motor?
I think all classes of insurance essentially the same principle applies, that you have a probability of loss over time. You understand that you need to receive a premium based on that to equate with that over time. You input your costs associated with that, be it reinsurance, be it your operating costs, and essentially you come up with, insurance companies at the end of the day do need to make a profit, like all businesses, but that profit needs to be spread over a period of time. It doesn't necessarily have to be all in one year. And so the component parts that you put together in order to put a premium together to ultimately get an outcome, there are many inputs that come to that, and it is spread over a period of time. So I wouldn't exactly say one class of insurance is more profitable than another. I mean, you can definitely look at data and you'll see that certain classes have that. But the reality is that all insurers, when they're involved in different products and services, will be pricing A, to make a profit over time, but B, to ensure that that profit is within the parameters which frankly would be of acceptance to shareholders and ultimately to consumers.
Because at the end of the day, you do need to be profitable and make earnings to ensure you can continue to cover it, right?
I think that's really important. I think the industry itself has to be sustainable, and that's good for society, it's good for an economy. You need to have, just as we have in the banking system, you need to have a strong banking system, and you definitely need to have a strong insurance system, because when things do go wrong, and in particular, as I mentioned earlier, in the event of a catastrophe, you need to know that that company is going to be there to support you through those tough times.
Is any part of this slow shift, as you say, to risk-based pricing, is any part of it kind of a customer acquisition strategy by insurers? Because somebody with less risk could get a lower price policy, therefore it's kind of a way to win those customers, even though some are obviously going to feel it in terms of their policies getting more expensive if they are in a more risky area.
Yeah, I guess that is the value proposition of risk-based pricing, that we know you, we know your location, and therefore here's a premium. How that sits and fits with the competitive nature of the market, that's really for consumers to be able to weigh up. And I think one of the things that I would also mention is that, I think we still have a market that has a high level of insurance availability. So consumers do have options and optionality. Risk-based pricing specifically could be beneficial for this party. It may not necessarily be so beneficial for another party, depending on the nature of their risk.
It's no secret, I think, Scott, that premiums are increasing. The likes of Tower have even come out. I've seen IAG's reports showing that your gross written premiums have increased by, I think, even in double digits in some cases.
That's correct, yeah.
What is behind those increases? Is it purely just inflation across the economy? And if so, how is that kind of justifiable? Where are you actually seeing that then be passed through to higher premiums? Can you just give us some colour on what makes up that increase?
Yeah, and again, I'm really keeping this at a level because there's obviously a number of factors that are inputs to that. But if we look at it, I mean, if we just take New Zealand, and probably the first thing I need to say is that we've got to remember that we're actually part of a global marketplace when it comes to insurance, and that's really important. And in that sense, we need to understand that, for example, reinsurance costs have increased quite significantly over recent times. And we only look at New Zealand in the sense, last year we had number 2 and number 3 of our highest insurable losses for natural catastrophes occurring within 10 days of each other. that being the floods over Anniversary Weekend in Auckland and then Cyclone Gabrielle. Those two events cost the industry about $3.5 billion. So, those factors need to be factored into operating costs of companies. We are seeing increasing levels of perils. We have seen inflation across, building inflation, repair inflation, availability of parts and services. All of those inputs have definitely had an increase on pricing. Companies are very cognizant of that, and clearly, you can't not pass on those increases, otherwise you'd be operating at a loss. If I can look to potentially a bit of a light ahead, as an industry, what we tend to do is we have to price based on events that have occurred in the past. When we're setting, we get our reinsurance costs, and then we look at the year ahead, we take into account the costs of our business, and we have to price accordingly.
And sorry to interrupt there, Scott,
Yeah.
That's always done on an annual review basis,
Well,
is it?
it's a rolling basis, but if when you're renewing your reinsurance treaties, they tend to be either at the half year or at the end of the financial year, and so you need to take those increased costs, and it's like an increased input costs into ultimately the retail services that you are providing. So we've overall, and being in the insurance industry, I always tap wood, I think we've seen in New Zealand in particular, we've seen a lower level of perils. We've seen that in the public domain, companies have come out. So we're hoping that actually should lead to a level of stability in terms of pricing. Now there's always factors that are certainly beyond my control. If an event occurs somewhere else in the world that could have a significant or catastrophic effect on the reinsurance market, could withdraw some capital from that then there's a little bit of a supply and demand model that's in play here, and that can have an impact on pricing. But from what I'm seeing, I think there is a level of stabilisation occurring, and certainly the levels of increases that we've seen in the last couple of years, we're sort of hoping that will smooth out. Insurance in and of itself tends to be quite a cyclical business, and pricing trends do tend to sort of, I won't say ebb and flow, but they definitely move over time, sometimes with quite significant changes.
If we use the major weather events that we had here, the Auckland floods and Cyclone Gabrielle, have we started already paying the price effectively for those events in premiums, or does it take longer to flow through?
Yeah, no, I would say that those impacts have definitely had an impact on reinsurance costs and pricing. Naturally, when you have events plural that sort of take $3.5 billion for payments. I mean, that's again what insurance is there for. But that definitely has an impact on the costs that you're going to be paying the next year. It's very much like if you have a claim. Oftentimes that is impacted in your premiums in subsequent years as well.
If I then just quickly take that back to that risk versus reward type of situation, it seems like New Zealand is pretty risky. So are we just going to have to continually pay higher premiums to ensure that our insurers stick around and continue to get a reward?
Yeah, it's a really interesting question. I mean, we're blessed, I think, to live in the greatest country in the world.
But we are an island nation with really crappy weather sometimes.
That's exactly right. At the end of the day, we're this little small rock right down the bottom of the world, and we are susceptible to earthquakes. We sit near some pretty big plates. We have volcanic. We obviously, I think in New Zealand, you're never further than about 200 k's from the coastline. We have sets of ranges that run down both of our main islands, which of course cause water runoff and all of those sorts of things. So you pull all of those things together, yeah, there is a bit of risk involved. But you can also have times where we don't have those types of losses, and we see much, if you like, more benign activity when it comes to claims. But yeah, there's no doubt that there is an emphasis on some of those higher risk areas that we ultimately have to contribute and pay for.
This then brings me from insurance affordability to insurance availability.
Yeah.
And are we at all looking towards a future, Scott, where some insurers just say, nah, too risky, and we can't get some policies at all?
Yeah, I mean, it's an interesting question, but I think that we are well served as a market, both in general and life insurance. I think we're also very lucky as a country that we have a number of insurers who have been operating here for many years, in some cases over 100 years. So we have, I think, stability in terms of the insurance companies that we have. Obviously there's some newer players, there's some innovation, there's what I would call opportunistic capacity that tends to come into the market and then get taken away at times, very commercially driven. Availability, certainly in the near to medium term, is not something that I think we should be concerned about. But as time goes on, and if we start to see increasing levels of climate-related losses, we may see some changes to the way that insurance is either sold and or consumers do buy it. Of course, much of our portfolio, in particular in terms of property insurance, is secured by some sort of financial instrument, normally something like a mortgage. And of course, insurance tends to go alongside a mortgage, which obviously demonstrates high level of insurability that we have in New Zealand today.
You made an interesting point just in there about consumers buying it, and insurers may not pull out of the market, but rather they might hike premiums to a point where it then becomes effectively unavailable to people because it is so unaffordable. Like, could that happen?
That's at the end, or a worst case scenario. I think I'd like to think with A, competition, B, still a good availability of capacity, that there is the ability to provide cost-effective pricing. I think policies and pricing and services. But you know, we may change the type of insurance that we buy. You know, it could be more subscription related, and certain classes of business, such as motor, where people are not always driving as much anymore. There's different products that, you know, and I think this also gives an opportunity potentially for innovation in the marketplace. I don't certainly have all the answers, but I think the insurance industry is very resilient. It's also at times needs to respond to those customer needs. So I think that's also very, very important.
Do you think there's enough competition in the market generally?
Generally speaking, I would say yes. I mean, at the end of the day, I've talked about natural hazards, and I, you know, but I also think we've got to be realistic. We're a market of 5 million people. We're a reasonably sophisticated market, and that's great. I think we've got some very good companies who are operating in the market today. I think there is still a high level of competition between those carriers, and I think that's always important because ultimately then, if you're a carrier, you've got to be on your A game. You've got to be providing the service, you've got to provide that claim service, you've got to have slick customer service, and you know, if not, customers can have options and they will vote with their feet.
It looks like a lot of brands are available to us, but really there's only just a few companies behind those, and then even fewer who are actually underwriting those policies that are on offer to customers. Can you explain underwriting to me and how populous the underwriters actually are in our New Zealand insurance market?
Look, I think we have, you're right, there are a couple of major players that have quite a chunk of the market, but they operate under different brands, different value propositions. Some of those are direct-to-consumer models, some of those are intermediated models, so the products and services are underwritten and sold through insurance brokers or insurance agents. So there's different distribution models. There's different levels of product service, from corporate products, which are very much individually written for a number of our major corporates. You know, you can't just sort of necessarily have a here's one I prepared earlier type business package model. They do take, you know, they've got unique needs and they need to be underwritten, and that's a skill, and it's important that we have underwriters within this market that understand those risks and are able to price those risks and provide the capacity. But there is also, you know, a lot of we're a nation of small businesses as well, right? So we need to be able to have package policies that suit the needs of our tradespeople and our smaller businesses, easy to understand, packaged together, and in many cases underwritten based on, you know, risk information, very quick to be able to fulfill and to be able to provide that service. So we have a real mixture. I think we definitely have good competition within the market.
In underwriting specifically?
Yeah,
okay.
Definitely, which I think is fine. Of course, much of our market is also driven on, and I mentioned earlier about the availability of pricing of reinsurance, because ultimately reinsurance is the insurance that insurance companies need to be able to support their retail propositions. And so that's a factor in definitely in pricing and underwriting as well.
I think reinsurance is such a critical part of this conversation, so let's absolutely go there. How do insurers secure their insurance?
Yeah, so there are a number of reinsurance companies operating globally. A number of those names are more well-known than other names.
Warren Buffett and his Berkshire Hathaway.
Which is an incredibly amazing organisation. I know a reasonable amount about, and they do incredible things globally. But we have a couple of major, German reinsurers, Munich Re being one of them, and a Swiss reinsurer, Swiss Re. But there are a number of reinsurance companies that do offer insurance support or reinsurance support to the direct carriers, and that's really, really important, because what those reinsurance and reinsurance in and of itself simply is insurance for insurance companies. There's a hang of a lot of complexity that sits behind that. There's the different types of programs that insurance companies buy. Some companies buy what's known as proportional reinsurance, so essentially the reinsurance company sits alongside the insurance company and follows the fortune of that company and shares in essentially the premium, and it shares in the risk. And then there's non-proportional insurance, where reinsurance, where companies provide layers of protection over and above certain limits that the company will take as a self-insured retention. There's a patchwork quilt, if you will, that supports the ability of companies to offer reasonable levels of capacity. Now, the reality is that insurance companies are able to sustain what we call working losses: car crash, house fire, business fire, or an accident. But when you have multiple losses in a catastrophe type event such as a Cyclone Gabrielle, obviously the quantum of those losses mounts up very, very quickly, and that's when the reinsurance partners often come in and to provide that support. So reinsurance is definitely important as a component part of an overall insurance offering, and as insurers, we're buying in a global marketplace.
I feel like we hear and see more of the non-proportional type being used in New Zealand. What does that mix typically look like, if you could give us a percent?
Yeah, look, I think you're right. I think there's a lot of non-proportional. I mean, again, the company I'm involved with in terms of IAG has a mixture of proportional. We have an incredibly strong relationship with several of the global reinsurers I talk about, who have what we call a quota share, so they share in each and every risk on the same proportion for each and every risk. They receive premium on that basis and they pay claims on that basis. But we also then have non-proportional, particularly when it comes to things such as catastrophe reinsurance, which allows us to buy larger limits of cover to support our business when it comes to a major or a catastrophic loss. So there's a blend of both proportional and non-proportional. I tell you, I love when I get together with the reinsurance team. We need to get a whiteboard out at times and work out what everything looks like. But it is actually really, it's also a capital effective tool in the organisation, being able to provide the level of support that it does do to its customers, and that's really, really important as well.
You spoke about the cost of that capital. We know that the cost of capital for mortgages, interest rates are high relatively at the moment.
Yeah.
What is happening with the cost of capital in the reinsurance market?
Yeah, again, if you just take, that's really demand driven, and what we have seen is obviously the cost of that protection for insurance companies has risen significantly over the last couple of years, and much of that has been as a result of global losses, but it's also been a result of losses that we see in this part of the world. And I'll give you an example. I mean, what's really interesting in the global pool of property catastrophe reinsurance, Australia and New Zealand actually contributes a little over 8% of that total global limit of property catastrophe insurance, which
that's
reinsurers,
a lot.
It is. I mean, and that's where you sort of see that we're actually disproportionate, if you will, to what we produce, but it actually demonstrates the risk nature of our markets, and we've talked about the types of risks that we see. So, that's interesting in itself. So it is definitely has cost us more to provide the protection, to have that protection on our balance sheets, which is really, really important. At the same time, we obviously have to pass on those increases in those costs. But as I mentioned, I think we have seen on a global basis, certainly at the moment, and I caveat this because I never know what's ahead, but we've seen a little more stability. We've seen some capital returning to that reinsurance marketplace, and therefore, hopefully that's a level of stabilisation in those prices going forward.
So based on that, given that we have to use up, as a small country, so much of their property capital, surely these reinsurers are viewing New Zealand as almost too risky to operate in?
Well, I think this is where it comes down to the relationships, right? The relationships that insurers have with reinsurers is absolutely critical. And the long-term relationships, it really is a partnership model. That I think gives those reinsurers a real sense of comfort, if you will, around how those companies are operating in this market, what they're underwriting, what they're accepting, and that's really important. You need to have that continuity of relationship in order to access some of these markets. But to give you an example, I talked about the fact that we have very strong relationships with our reinsurers at IAG. We absolutely do. And I talked about sort of 4 core relationships that we have in terms of our quota share treaty, and those are exceptionally important. But when I look at our overarching reinsurance program, we actually have participation of over 40 reinsurance companies on the totality of our program. So it demonstrates that 40 reinsurers like what they see we're doing in this part of the world, and I think that would apply to other carriers as well. So we have to be consistent, but I think it's absolutely based on those relationships. An increasing understanding of the risk environment is always going to be the case, but at this point, that's what gives me the confidence to say that, you know, on a continuity basis, that insurance is absolutely still going to be able to be offered within our market.
But wow, that just speaks to the real complexity of insurance. I mean, Scott, you know that I cover a lot of industries, from space through to, I've even done gold recently, and using, you know, acronyms like gold per tonne, but I think I can say that insurance is easily the most complex. I
think it is complex, but we need to, as an industry, I think we need to simplify it as much as possible. Those are operational issues. They are factors that definitely take into account our pricing. I think our teams do incredible work in terms of putting together a package of companies that will support us in providing that reinsurance capacity that we can ultimately then sell the products and services that we do to the markets that we operate in. And I speak, I'm sure, for the other carriers that are operating in this market too. It is those relationships that underscore, I think, that the ability to offer the capacity and the products within New Zealand. So yeah, it's pretty important. And at times it is complex, but we often make things more complex than they need to be as well, I think.
You have done an incredible job of explaining it, so thank you so much for that.
Pleasure.
I did just have kind of one cheeky question towards the end that I wanted to ask you. Are there some things that you hate people doing? Like, as an insurer, I remember a story that I think was from some ACC claim data that showed that the number of people that were using knives to take pips out of avocados and slicing their hands on them was a real bane for the ACC. Yeah. Are there some things that you see people doing, just go, please don't do that, it's going to end in an insurance claim? I immediately go to some of those ACC stories, you know, and absolutely the cuts that we sort of see in wintertime when people decide to make pumpkin soup and at the same time, you know, are slicing their fingers, or individuals that end up burning their backsides because they get home late in winter and turn the heater on and then fall asleep. You know, those are funny stories, I know, and they're not so funny to the individuals that I'm sure they're okay now, and I'm sure ACC helped them along that journey.
Look, I don't know. I think, in all seriousness, I think we need to look at some of the increasing type of claims that we're probably seeing with things such as lithium batteries and you know, those sorts of things, which definitely are risks that weren't necessarily there 10 years ago that are now starting to take place. So I think we need to look at education. We obviously need to continually always look at prevention, and I think it's certainly, I think as insurers, we also owe a duty of care to our customers to communicate as much as possible around what are some risk prevention techniques.
Thank you so much for your time, Scott. I really enjoyed this chat. I appreciate it.
Pleasure. Thanks, Madison. Good to see you. Cheers.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.